Yes, I mean, gold's had a tremendous run, and I would say it's probably been in a bull market now for the best part, perhaps even more than 10 years. That's not to say it hasn't been without its problems. I mean, we hit a new all-time high in nominal terms earlier this year, not in real terms, because if you adjust for inflation, we would probably be looking at a level nearer to $2,500 than $1,900 per ounce. One of the major reasons for the surge in interest in gold has been the wish to diversify away from fiat currencies. And by fiat currencies, I mean those currencies that are backed by nothing other than the faith in the government or the central bank who issues them. Now, gold is real. It has served as money for thousands of years. It is a divisible medium of exchange, and people are and investors in particular are coming to see its value. It is also, for the last 20 years, central banks have been net sellers of gold, and now we have seen that turn around. And part of the reason for that is for developing countries in particular, this is emerging markets, countries who are running big trade surpluses, they are building up their foreign exchange reserves. Now, they're concerned about the devaluation that's going on with all the money printing that's going on in the dollar. There's been an undermining of the euro to a great extent, and they're really concerned about how their FX reserves will hold up in the future. And for that reason, they're starting to diversify those FX reserves into gold. And they're doing that in much greater numbers. And if we think of an example, for instance, if we think about the developed countries of, say, France, the US, Italy, I mean, these are countries that have gold reserves as a proportion of their FX reserves of around sort of 60–70%. By contrast, China, which has by far the biggest FX surpluses in the world, its gold holdings only account for about 2% of its foreign exchange reserves. So obviously it has a lot of leeway to go to diversify further.